Joined by Mark Todd, who's with us from FIIG Securities. Todd?
Morning.
Mark Todd. I just call you Todd. Mark, I know you're Mark. Mark, good morning. I mean, is this something that we should start to expect more of when we go into 2013?
I think the idea of a bond sell-off is something we live in hope. At the moment, there's the investor demand is that they want anything with a fixed income return that gives them some comfort. So let's presume that the cash rate stays at 3%. Most people expect it'll go lower. If you can get anything that's with a 6% return with cash at 3%, that becomes very attractive to a lot of investors, and so they'd be looking for any of that sell-off. At the moment, it's more closer to 5 3/4, 5.5. Anything around 6 would be terrific for a lot of people.
It's that old chestnut, is it not, though, of locking yourself into a position where, fine if it's kind of on an annuity basis, but if you need to, if you need to kind of tap that investment tomorrow, it's about having that, I suppose, liquidity in whatever investment class you're in. Sure. Just walk us through that one.
Well, I think it's the liquidity in the bond market is extensive. I mean, down here at FIIG alone will turn over $10 billion in bonds this year. So the idea that there's no liquidity in the bond market probably isn't an accurate representation. The problem that we're talking about there, Carson, is the attitude towards the bonds. The bonds are the last things you want to sell because of that consistency of earnings. So you're in the riskier assets, you're in the equities, you want liquidity in that because that's the riskier piece. Then you move up that capital structure into the things that you'd sell last, because if Telstra provides a 7% return, you may just want to have that income because that provides with the lifestyle choices. Whereas if you're looking to trade, you might have bought a Fortescue in the hope that they would be able to do something better in the Pilbara, and that would start to rally up, and then you could trade the equity itself. But in terms of bond turnover, over the counter, the hybrids that have taken place, the exchange traded bonds, there's an enormous amount of turnover, but it tends to be the last asset you look to sell. In terms of liquidity, if you look at the commercial markets, the commercial property markets, they're probably a little bit less liquid, and a lot of people are piling into that because they need to get the cash flow return. So the investment psyche is changing at the moment around trading, volatility and longevity.
Mark, is there a sense, I suppose what we're talking about is as risk picks up, it doesn't necessarily have to come at the expense of other more defensive kind of options that are still out there. They're not kind of dumped en masse and people jump to the other side, as maybe we previously used to talk about.
Yeah, I think if you were to talk to your equity agents, they would suggest that the money, the rates are moving well for everything's going in the green, it looks all great, but the volume isn't extensive, and it's certainly not coming from the street that it traditionally did, where everyone was piling into the equities and a balanced portfolio with 70% equity, 30% cash. That's a misnomer that won't be coming back at all. So let's suggest that if they had $100, maybe they're putting that $50 back into the equities. It might grow to 70. It's unlikely, but let's say it did. Instead of just being in cash and cash only, they'll be in a fixed income piece that will give them a distinct anchor to their portfolio around stabilising the portfolio.
Mark, on that note of stabilisation, we'll say